Welcome to Zen and the Art of Real Estate Investing. What if you could learn from experienced real estate investors, find out what got them to where they are now, get insight into their daily habits, and take these insights to inspire your own growth? Each week, Jonathan Green shares an in-depth look at the mindful approach to real estate investing. Jonathan is a real estate investor, advisor, and coach, as well as the founder of Streamlined Properties and the team leader of Streamlined Properties on Market, brokered by eXp Realty. Whether you are looking to start from scratch, get to the next level, or just a straightforward and honest approach to real estate investing, Jonathan seeks to provide a free mentorship program you can take with you anywhere. Now, here's Jonathan.
Welcome back to another week of Zen and the Art of Real Estate Investing. I have an amazing show for you today. Before we get there, I just want to remind you about the 10-minute clips on my YouTube channel. Great way to put the face to the name, see what we're talking about, then listen to the podcast in the car, while you're walking, at the gym, whatever you do. And then when you're done, leave us a 5-star review if you're getting that value out of the podcast. This week, we have the author of The Hands-Off Investor. He's Brian Burke. He founded Praxis Capital. You have to know who he is. And if not, you're going to get so much knowledge from our conversation. I can't wait for you to hear it. Let's go. This is episode 69 of Zen and the Art of Real Estate Investing with my guest, Brian Burke. Brian is the president and CEO of Praxis Capital, a vertically integrated real estate private equity investment firm. You probably know Brian from his book, The Hands-Off Investor, an insider's guide to investing in passive real estate syndications. He's acquired over $800 million worth of real estate over his 30-year career. Brian, welcome to the show.
Thanks for having me here, Jonathan. This is going to be fun, I think.
Yeah, no, I'm really excited. I like to start here because it's a question a lot of people don't get a lot. But when you were growing up, were you interested in real estate?
Not at all. I had no idea anything about real estate.
That's why I asked, because I think people are surprised that 50% or more really had no interest, growing up. It just wasn't a thing. What was the first time that you remember being like a little bit interested in real estate?
It was probably, I was around 18 or 19 years old. My parents got a foreclosure notice taped to the door, and then somebody came to the house wanting to buy the house. And I didn't really understand any of that, what was going on. And I thought, well, that's it seemed kind of interesting about a year later when I was reflecting back on it and thought, like, I wonder why that guy was here. And, what was motivating him to do that? And what's this whole foreclosure thing anyway? I've seen the notices in the newspaper about notice of trustees sale. And it just got me to thinking. And I thought I had to explore and figure out what all was going on. Geez, I never looked back.
Yeah. Was it like the entrepreneurial end, or was it like a money scale end, or just something that seemed like this could be something?
Well, I mean, I couldn't spend my whole life selling golf balls where the golf cart crosses the path, because we used to catch the golf balls in our backyard. Then I'd put them in an egg carton and sell them to the passing golfers who probably just lost them. I couldn't do that forever.
Yeah.
So I think it
limited scale there.
Yeah, there's a lot of limited scale. So I figured it had to be the entrepreneurial side. I used to sell pomegranates at the side of the road that my grandmother grew on her pomegranate tree. So I guess I must have just always had that somehow.
Yeah. And so once you thought foreclosure, what was the first thing? Because I think there's a lot of people out there who are interested in foreclosures, but they've generally dried up since the pandemic. So what did you do? And this is a while ago when you're interested in it. So what did you do to get the ball rolling with foreclosures?
Yeah, this is the late 1980s.
Yeah.
So,
I was doing it with my dad at the same time. So I remember the days. For me, it was, we would go to the clerk's office. My dad was an attorney, so he knew everyone at the clerk's office, and they would just give us the big list. Like, it would just be printed, and we would go through, drive by all the foreclosures, go push me through the window of the ones, because it was just a different time. People don't understand this. How did you get started with it?
Yeah, kind of the same way. I started cutting the notices out of the newspaper, the public notices. I would cut those out and, I'd tape them to a piece of paper, and then I would have like all these notes flying around of what was going to auction. That's kind of what led to me getting more sophisticated in this business. Is I would I would attend the foreclosure auction, despite the fact I didn't have a dollar to my name. Here I am at this foreclosure auction where you have to pay full cash at the time you make a bid.
Yeah.
But I'm showing up, because I got to learn. I got to see who's doing this and how they're doing it and learn about it. And what I was noticing is like everybody was like shuffling papers around. They got file folders everywhere and everybody's disorganized. And I'm like, there's got to be a better way. So I wrote my own software. I decided I'm going to spend time figuring out how to write my own software to like keep track of all this stuff. So I literally like made this whole software platform that I could take a laptop into the county recorder's office. And I literally would sit there for hours and hours and hours, several days a week, researching title to all the foreclosure sales that were coming up. And I could input all the information from each lien or loan or deed or whatever that was on record and input it into the software that I created. And it would automatically prioritize all the liens and come up with like a title report and everything. And so I could show up to the auction and I would have this printed out list of everything that was going to auction that day. And like everybody was like blown away. They were like, well, they're shuffling through all these notes and I'm totally organized. And I had all the information. And I did that for, it was probably 4 or 5 years before I actually made my first auction purchase. So it was a long learning and development process.
Yeah. Were you helping other people though, as your program got better and everyone's like, what's this kid doing here with this stuff? And then you had the data. Did they want what you had?
Oh, of course they did. And I wasn't going to give it to them. No way. I was trying to build a business as an investment company, not as a software service provider, which probably, in retrospect, maybe it wasn't the smartest idea because I didn't have any money to actually buy any of these properties. I probably could have made some by selling the software, but then I would have just been in the wrong business. That wasn't the business for me. Real estate was really where I seem to have been drawn.
Yeah, but it seems like you had a long-term mentality, which I think is one of the troubles with just the new breed of investors. They want everything quick, so they're looking to get a quick return. But you were in it for the long haul from the start. If you can go there for 4 years, not buy anything, and also not share it, you must have known like you were onto something.
Yeah, I had a feeling and it paid off because, in like 06, 7, 8, 9, 10, 11, that whole period, there was a massive avalanche of foreclosures. And it was absolutely perfect for me because I had this great system in place where we were literally tracking hundreds of foreclosures auctions per day. And, with the old way of doing it, we never could have been able to track that volume of data. But we were ready for it. And so it kind of was like, you prepare, and then finally your day comes and all that preparation, you're shown why you made all that preparation. And we made a pretty substantial business out of that little, after hours project.
Yeah, I think maybe some newer investors who haven't been to courthouse steps don't understand why the preparation is so important. So many of them get continued each time. You go, there's a lot of, say, like 70, and maybe only 20 are going to come up, and maybe 10 would be on the list, and 10 just like appear out of nowhere. Is that the same experience you had? But you were able to just go through your data and say, oh, here's 123 Main Street looking good.
Oh, yeah, absolutely. You nailed it. And the funnest part for me always was when an auction would come up and I would bid on it and get it while everyone else was looking at each other like, where'd that one come from? Why didn't we know about that one? How did he know about that one and we didn't know about that one?
Because they're relying on the ridiculousness of the courthouse docket, which has never in the history of the world ever been completely correct. There's always oddities that fall on and fall off. So that's a great one. Whenever somebody doesn't know, you're the only person with data on it because they were looking at the pre-planned list, which again, most aren't going to be there.
Yeah, it's true. And this was just when the advent of like websites were coming out that had all this data too. So there was a point there where everybody was relying on whatever the website had. Yeah. So if the website dropped the ball and didn't have the auction on their calendar, which was a third party service, there was no obligation. Yeah. It's not like, oh, the sale was invalid because it wasn't on this website. Now, this is a website that investors would subscribe to. If they missed it and I had it, then I'm getting this thing at the opening bid. And other people are bidding everything else up to the moon because everybody else knows about it. That's where some of the best deals are made. The best deals are made kind of in the shadows where nobody's looking.
Yeah, but that's smart though. Yeah, it's like if they're, an investor has four properties, three of them are super appealable to everybody else, because they kind of maybe look better, but the smart investor is looking at the one that's the biggest dump who they can get the best deal on that they want to get rid of. You're figuring that out at an auction level, which moves really quickly. So without the data, you can't really participate because you wouldn't know anything.
No, by the time that they had figured out what was going on, it was already over. I mean, these things sometimes last 30 seconds. So
Yeah, exactly.
if they weren't ready, they can't do all the research that quickly.
Yeah. So at that time though, were you doing drive-bys on some of the properties? I used to go with my dad. We would drive the list and just like see which ones were in the worst. My dad would knock on every door, and then we had a thing where we would see which ones. A lot of them would have yard sales, so we go to the yard sale, buy some stuff, and then he'd strike up a conversation. What was your driving thing for this, or how many of them were you looking at, or were you just running the data because you had it in your system?
Oh no, we were looking at each of the properties. I developed this whole checklist
Smart.
inspection system where I could pull up to a property, and in about 30 seconds I could have a full condition report on the property, a rehab budget, all that stuff very, very quickly. Because especially this became really important when there was this massive amount of foreclosures after the great financial collapse. We were looking at dozens of properties a day. And, I wasn't the guy that shows up at the auction and bids sight unseen. We had seen every property that we bid on, and we were one of the few that had. So, then you get into this whole thing where everybody else is bidding on it just because we're bidding on it. They're like,
Right.
oh, Brian looked at it.
Yeah.
So, it must have been good or he wouldn't be bidding. So we're going to go ahead and bid.
Yeah, but they're really bidding blind, so you could really play poker games with them at some point to say, well, let me just see if I go out early in a low bid on this one and see if they all overbid it so they lose their money for the next one.
I'll reserve all comment and not make any admissions in a public forum of things that might have gone on.
Yeah. Well, so when you were doing the drive-bys, did you ever we would knock the four doors around and we would always get the full story from the neighbors. It's like you knock the foreclosure, they're pissed off. They don't want to talk to you. Maybe it's a tenant. You knock the neighbors and they're like, yeah, can you help me get rid of this dump, the only dump on the block? Did you have any experience with that, checking in with the neighbors across the street?
Oh yeah, neighbors are our best friend, and vice versa.
Yeah.
The neighbors really loved it when we were knocking at the door because that means that the garbage dump across the street is coming to an end. So yeah, neighbors definitely like to cooperate. But I was always uncomfortable with door knocking. I was never the door knocking guy, but boy, I tell you, when we started hiring guys to do all of our driving for us, I made sure they did it.
Yeah, but like I'm a total introvert. I don't like door knocking, but I found when I did do it, I would do it for myself and for clients on the foreclosures. Like you were saying, those neighbors and on each side, they were so appreciative because you were trying to buy something to fix it. Where they always saw it as an eyesore or there was crazy things. There was a hoarder's house and there's a bunch of stuff in the yard. So I think like that made it a little bit easier for me, even though I'd really rather not.
Yeah, I'm with you there. I felt the same way. I'm a little bit more introverted as well.
Yeah. So how did you start to scale this up into a full scale business, which eventually turned into Praxis Capital?
Well, it was just an organic process of growth, really. Foreclosure volume grew massively. And so we were buying, fixing, and flipping, at one point, like 4 or 5 houses a year. Then it grew to a couple dozen houses a year. And then about 04, 05, 06, it was like no houses a year because I was just afraid the market was going to tank. It was just ridiculous. And then the market did tank. And then we were doing 100 houses a year at the flip of a light switch.
Yeah.
And when we were doing that, we had to raise money to do that kind of volume. So we were reaching out to folks and bringing on investors to invest in these deals. And at some point, I just looked at it and thought, you know what, all these foreclosures are going to be gone sooner or later. We're going to get through all this backlog and all this stuff. And now we've got all these great investors with all this capital. And, what are we going to do with it if the foreclosures are gone? How are we going to invest for these people? And that's when I decided multifamily was going to be our path. And I got into multifamily in 2002 on a personal investment when I did 1031 exchange of a couple rental houses. I got out a couple rental houses into an apartment building and thought that was going to be the way to build kind of like some retirement wealth. But now when I was faced with the situation, I thought, you know what, I could actually build a business out of this, not just a retirement, but I could actually build a business out of this by taking these investors who are investing in all these foreclosures, and we can start investing in multifamily. So that's exactly what I did, and started buying down in Texas, and then since then just expanded into several states and several thousand units.
And that seems like a good step up too, because foreclosures are, I mean, I don't consider them risky just because the prices are so good, but there's a lot more that goes into it. You got to fix them up, get them back on the market. The neighborhoods are developing. Stepping up with those same investors from foreclosures to multifamily, where there's like, wow, generated income could be coming in if you're buying one that's already fixed up. That must have been kind of like an easy transfer of the capital from one to the other.
You would think, but surprisingly, it was a little bit more difficult than one would
Really?
expect. Yeah, it
Yeah.
really was interesting because there's mindset differences between investors, right? And so
Yeah.
when you build a business of flipping houses where you're in and out very quickly, people have an arbitrage mindset where it's like, okay, I'm making this investment. In 3 months, we're out, we're getting our profit. We have very little exposure to the market.
Mm.
And, at the time, remember this, when we really started this massive expansion, it was, the great financial collapse was still, in people's memories. And people didn't really want to be exposed to the potential of having another collapse. So they were afraid. They liked flipping because they felt it was lower risk. Now you're asking them to make a long-term commitment, make a 5-year bet on the market. And it was a stretch for a lot of people. And some people never got there. Some new people that never would have invested in the foreclosure deals came on board because they're like, yeah, hey, that stuff doesn't interest me, but this is really interesting because there's income. And so it was an interesting evolution, and it doesn't always go quite the way you think, but it eventually grew quite large.
Yeah, those are great points because I really wasn't thinking of it. But now that you say it, like it absolutely makes sense because that's a quicker money scale for them. They can get in and out, they can get back their money, reposition it, do something else. But the commitment of being involved in a multifamily syndication could be a 2-year turnaround, like you said, could be a 5-year turnaround. And a lot of people don't want to do that, even if the scale might be larger in the end.
Yeah, and at the depths of the GFC, I mean, we were actually telling people these were 10-year deals because, we didn't know how long it was going to take for the economy to come back and the real estate market to come back and produce enough appreciation and enough rent growth to, develop a meaningful return. And, we're projecting returns kind of in the, mid to high teens at the time. And, it just takes a while to get there. And so some people didn't want to put their seatbelt on for that long of a ride. They like to get in and get out. That's the one thing that's interesting about investors, the first question that they have for you as soon as they hand you a check is, when do I get this money back? Right. And the sooner your answer, then the more comfort they feel. And the longer it is, then the more anxiety they feel. And I totally understand that. I'm the same way. I'm a passive investor too in other deals, not just an active participant. I understand that. I want to know when I'm going to get my money back too. So I get it.
Yeah, it's interesting because my mindset when you were saying that, I was thinking like, I would never say that. I would just say like, what's my return? But then right as I was saying that, I was saying to myself in my head, well, maybe not. I really do. I kind of want the opportunity to have the money back, even if I don't want it. I think that's part of it. Like you could get it back earlier and you can't really pull out if you know that the window's 5 years. So that's got to be part of the kind of, mindset of it as well.
I have several investment funds that have liquidity options where you could get out at the end of any calendar year in a couple of them. I have another one where you can get out on 60 days notice. And it's funny, when investors are signing up, they always want to know, what's the notice provision? What's my minimum requirement? How long do I have to have my money tied up? It's 60 days or it's 1 year or it's 6 months or whatever the case may be in some of these investments. Now, obviously, we can't do that with long-term buy and holds like multifamily, but we have other funds like flip funds, a debt fund, and so forth, where we do have liquidity. And that's always one of the first questions. And people will make the investment sometimes because they know that liquidity option is there. And that same investor, I tell you, I have so many investors in these deals. I have some that have been in there for over 20 years in the same fund, and I have others that have been in there for multiple years. And, they don't exercise the liquidity option. They just want to know it's there. It's a comfort.
It's funny, though. They could be in 20 years, and the only reason they got in is because there was a 60-day out. And
That's
it's 20
exactly
years
right.
later.
That's exactly right. And the funny
Yeah.
thing is I had some people, I remember I had some investors that came in, they were saying, this is my kid's college money. I'm putting this in here. I need to know, how long it's going to take me to get it out. And the only reason they ever got out is because their kids grew up and actually went to college and they had to pay for the college. That's how long they were in there.
Yeah.
So
Yeah.
it's kind of a funny thing.
Can you explain a debt fund too? People have talked about it a lot, but I don't think your general investor really understands what a debt fund is.
Well, and most of the times when people are investing passively in a real estate syndication, it's generally what's called an equity fund. And an equity fund means that you're buying a piece of this real estate. So let's say we're going to go buy a 100-unit apartment complex for $10 million. I'm just making up numbers.
Yep.
And I say, I'm going to need $3 million of equity to make this happen. I'm going to go borrow $7 million and I need $3 million. And that's going to give us the $10 million we need. The investors are the $3 million portion. It's equity. A debt fund is different. In a debt fund, we're actually buying debt. So instead of going and buying an apartment complex, I might buy the loan that is lent against an apartment complex. So the difference to me for the investor, there's a couple of main differences. In a typical equity fund, you get distributions when and if the property is producing cash flow. And generally that takes a period of time for that cash flow to materialize. 1 to 2 years before distributions start is not uncommon. In a debt fund, as soon as those interest payments start, which is usually the first of the month following when the loan is made, there's cash flow coming in. So there's an immediate instant return. It's something that in the past never really interested me much because the returns aren't stellar. The returns are kind of like 8, 9, 10, maybe 11%, whereas we were doing 15 to 50% returns in equity funds in our real estate investments. So it isn't as sexy, but at a time like this, a debt fund feels really, really good because somebody else's money, somebody else's equity is in first loss position. So if, their things go to hell in a handbasket, somebody else is losing money before we or our investors are losing money. So it's just a comfortable place to be. It's a steady, kind of more cash flow, lower risk, lower return type of fund. But I think it's appropriate for where we are in the market today, which is a lot of uncertainty and a little bit more risk.
Yeah, that's what I've been hearing. I've heard there's just more good debt out there to get now than there is in other times just because of the state of the market.
Yeah, I think that's true. And there's also opportunities in debt. And, as credit tightens, that means that borrowers are having to go to so-called non-traditional lenders to borrow. And that's going to put more of that debt out into the marketplace and gives us additional opportunity. It's a field that I never would have imagined myself being in if it wasn't for the fact that 5 years ago, we started up a debt lending company that really took off and we sold it last year and we got an offer we couldn't refuse, but that put me into the debt business and it gave me an inroad into, being able to buy some really quality debt products for our investors, which has been kind of a really nice benefit for them.
Yeah, it sounds like you as an investor and through Praxis Capital are pretty diversified within real estate. And that's one thing that I always say to people who don't get real estate. Like, sure, stocks are fine. I invest in stocks too. I'm not into like crypto and that stuff. It's not for me. But like real estate, just as a whole, you can be like completely diversified. Is that something that's been important to you when you're building funds to have just different types of asset classes that people can invest in? Or fund classes?
Kind of. Yeah, I'd say yes and no. And this is kind of it's a weird answer. So I've done just about everything there is to do in real estate. I've developed real estate. I've built self-storage. I've subdivided land. I've built homes. I've done all that different stuff. What I've come to learn in this business is that I'm maybe a 1.5 trick pony. I'm really good at just a couple things, right? I'm good at buying foreclosures, fixing up houses and reselling houses through foreclosure. And I'm good at buying apartment complexes. And now I'm actually getting good at buying debt. So maybe I'm a 3 trick pony now. But whenever I strayed outside of my core competency, I always would get my hands slapped. Fortunately, never my investors. I've never lost a dime of investor principal in 34 years of doing this. But I've certainly taken my own lumps. And it usually happens whenever I try to do something really off balance. So, I started getting into, hotels and like just other stuff, and it's just a mess. So So I stay focused in my business as an active participant. I stay focused. We're doing just those three main things. Our primary business, though, is multifamily. So that's really what I stick to. But I believe in and encourage diversification on behalf of the investors who are investing capital into these ventures, because you don't want to have a single point of failure. And I cover this a lot in the Hands-Off Investor about talking about, if you're giving up your hard-earned money, don't put it all in one asset class. Don't put it all in one geographical market. Don't put it all with one sponsor. Spread your money around and spread your risk around, because there's always money to be made in real estate somewhere. You just have to figure out where. And so one of the things I like about multifamily is, maybe it doesn't work in San Francisco, but it might work in Dallas. Or, maybe buy and hold doesn't work, but you can buy, fix, and resell. Or, there's always just a way, there's an angle to make it work without straying too far outside of the box.
Yeah, you talked about your book, and obviously I mentioned at the beginning, but I found one of the most important parts of the book for me was the part in the beginning where you're really going over how to vet a syndication and the GP and the deal. And I feel like that's so important because there's so many shiny objects out there now. There's syndicators who really are not syndicators. They don't know anything. So that whole part, I think, is so relevant to right now, because you have to vet the person in charge to know whether they can handle if things go wrong, what their deal flow has been. And like you said, you can say confidently, I've never lost investor money. You want to know what they're doing. When you were writing that book, was that something that was so important to you that you learned along the way? Because I think that's what people could be missing right now.
I think that's right. I think people, if they're going to make an active investment, they understand what they need to know. So let's say you go, I'm going to go buy a rental house. People will understand just intuitively that they need to know if it's a good market, if it's a good neighborhood, if it's what it's going to rent for, if they're paying a good price. They have a fairly decent understanding. Almost anyone would have a fairly decent understanding of how to get into that type of an investment. Where people tend to lose all focus is when they make a passive investment in a real estate syndication, because they kind of understand the real estate component, but they lose sight of the fact that who they're investing with is, if not as important, more likely, in my opinion, more important than what they're investing in. And it's difficult to quantify or figure out if who you're investing with is worthy of you making that investment with them. And it's a challenging thing for people to do. And so they tend to dismiss that and focus on the deal. And the evidence of that is when people will say, how do I find one of these syndication deals to invest in? It's like, well, you're asking the wrong question, because it's not about what deal you invest in. It's how do you find the right sponsor to invest with? Because once you find that, they will bring you the right deals to invest in. And that's really difficult for people to make that connection.
Yeah, because I could just see it as you were saying that. Someone says well, I don't have the money to do this, but I really like to be involved in apartments in Houston. There's a lot of people involved in apartments in Houston. And if you're not focused on the operator, you could go wrong real quickly. First time operator in Houston with a downturn market could be a big problem, as people found out, in 2008.
Yeah, they didn't find out just in 2008. They found out in 2023 as well, because it's funny you mentioned Houston. There was just a foreclosure down in Houston of over 3,000 apartment units by an operator that had only owned some of these properties for less than 2 years.
Yeah.
So it can happen that quickly, and that's just a function of investing with the wrong operator. So it's extraordinarily important.
Today's show is brought to you by Streamline Properties on Market, brokered by eXp Realty. That is my on-market real estate team. We are investor friendly. We work traditional buyers, sellers, but we also work the investor sphere all the time. House hacking, short-term rentals, flipping, long-term holds, anything that you want to do. We're experienced in that arena. We work the whole state of New Jersey, Philadelphia County in Pennsylvania, Elko County in Nevada, and the Catskills region of New York. So whatever your investor needs are, you can count on us. You can go to streamlined with a D.properties. Let's get back to the show. Yeah. So how did you come to write the book, The Hands-Off Investor? I know it was a Bigger Pockets collaboration, but so many people have told me about the book, and now I'm finally in it, reading it, getting through it. It's helped me so much as someone I've literally been doing this for 30 years, but I didn't really think syndications because I was always doing my own thing, kind of like you were in the beginning. But now it's so much more interesting to me. And that book is really like a great guide on the way in. How did you come up with the idea to start writing it? And then how did that all work out? Because it's been around for a while. It definitely helped a lot of people.
Well, it came about from a lot of different things all coming together at once. I'm friends with several other Bigger Pockets authors. And just in having conversations with them, I would always say, like, man, I don't know how you do this and write these books and where you find the time for it. And Brandon Turner is one of their biggest authors. And he gave me some advice one day about how he prepares for writing a book. And, of course, Brandon has a knack for making the most difficult things sound extraordinarily simple. So I thought, well, that sounds really easy. I could do that. And then, of course, you realize 9 months later how much work you put in. You're like, this isn't as easy as I thought.
Yeah.
But it at least got me going. And then just coming up with a topic was kind of difficult. But, Brandon gave me some good advice. He's like, what do you need in your business? I'm like, well, this is a business that thrives on investors. He said, well, then write a book on how to become an investor. And so after thinking about that for a while, I reflected on a couple things that were really important to me. One was that a friend of mine had made a passive investment into a real estate syndication and lost her entire life savings because the sponsor that she invested with turned out to be a crook. And I thought, if there's something I could do to prevent that from happening to just one more person, the whole effort would be worth it. What could that be? The people need to be educated on how to make these investments. And I reflected on all the investors that I've talked to over the years and the questions that they've asked and thinking that, they're asking me all the wrong questions and they're not asking me all the right questions. Why is that? Well, because nobody's actually put out information on how to be a passive investor.
Yeah.
There's thousands of books out there on how to be a real estate investor, but there's no books out there on how to actually be a passive investor in a syndication. I'm like, that's what I need to do. I need to write this book because it hasn't been done before. I didn't want to just do something everybody else had already done.
Yeah. And I mean, it really does make sense. And I think it's something we talked about in the beginning, long-term, short-term. People see the opportunity in syndication. Maybe they're even, experienced, but they just want to I just want to get to the money. So here's some money. But what you set up so perfectly is all the steps you need to do in your due diligence before to make sure that you want a safe passive investment. So why would you bypass all the steps to get there or know nothing about it? It just doesn't make sense to me, but I really think it can help people kind of open their eyes and they'll do way better on syndications and building relationships. And so, I mean, based on all this that we're saying, if you find the right syndicator and right operator, like you can stick with them for years with different funds. You must have clients that just, like we were saying, they're going to keep coming back. They'll try out, a different fund that you have available because you've built that trust over time.
So I'd say the majority of our investors, over half of them, have invested in multiple deals. And we have some that invest in every deal we do. It doesn't matter what we put out. Every single one, they're writing us $100,000 check or more.
Yeah.
To invest in every single one. And it's true, there are a lot of repeat clients. Now, I always encourage people, don't just stick with only one sponsor, though. I mean, when you find a good one, that's gold. Definitely invest with that sponsor over and over again, but don't make them the only sponsor you're working with. Too many people have put their entire life savings with one person and then had something go wrong, even something that might have been outside of that sponsor's control, like a death or, who knows what, and they find themselves in a world of hurt. So, spread it around a little bit, but definitely don't spread it with groups that aren't worthy of being a steward of your capital.
Yeah. And I mean, if you're really comfortable with one, I'm sure somebody like you could say like, oh, actually, these are vetted sources also, even though they're, technically competition. I don't really see real estate investing as much competition because there's so much opportunity for everybody out there.
Yeah, there are. And, networking is a great way to find other people to invest with, and especially networking with other passive investors. Personally, I don't recommend anyone, and I do that on purpose because there's only downside in it for me. Having written the book on passive investing, if I tell somebody, oh yeah, John Smith, he's a great sponsor, and they invest with him, and then something happens or goes wrong, God forbid, there's only downside in it for me. You recommended this guy, and look what happened.
Right.
So I personally don't, but But for passive investors, always want to share their successes, right? And
Yeah.
and so say like, oh yeah, I invested with so and so, and he's been giving me reports on time. I get my K1s in time to do my tax return. They really seem to know what they're doing. They got a really strong management team. That's the kind of stuff you're looking for. And there's actually, like, I want to say support groups, but there's actually groups out there that are passive investor centric that, passive investors can network with each other and, talk about us sponsors behind our backs and that sort of stuff.
Yeah. Well, so over the years, what's been the hardest part about like getting to a next level? Whether it be when you kind of feel like you're at a plateau, it seems that you keep getting up to a next level. Where was the trouble part over your 30 years where you thought like, I don't know if I'm going to be able to stick. How am I going to get to the next level?
I think when the 08 collapse, 08, 09 collapse was a very difficult time.
Yeah.
Because everything was just in the tubes and nothing was easy. And raising money was extraordinarily difficult. Everybody thought real estate was catching a falling knife. And, so there was a lot of wondering if this was ever going to go anywhere. And, where am I going to like have to go back and work for a living again? Or, what am I going to do? I chose to grow my way out of it, which wasn't the easy path, but certainly was the right one. But there were times it was extraordinarily difficult. I know personally, I had to almost start over. Like I said, thankfully, knock on wood, I didn't lose any investor money, but personally, I was almost wiped out. So it was very, very difficult, challenging time, and I could have easily just given up, but I didn't. And thank goodness for that, because it's been a good ride from there.
Yeah. Were you overly in one asset class at the time, or was it just the collapse, I think, just bottomed out so many people? I was fortunately at the time, I was just mostly single families. But unfortunately, I was in the middle of selling two in Florida and moving to New York. And like, that was like, Florida was like the epicenter of the disaster when that started happening. So I took two huge hits that I could have avoided. But what do you think? Is there anything that you could have done differently that now you take with you, into the new way that you're doing it?
Everything was difficult. I can certainly say that. This impacted all sectors of real estate.
Yeah.
Now, fortunately, what it also did is it created an incredible opportunity. I mean, I wouldn't have had the opportunity to do 100 foreclosure purchases a year or more that we were doing if it wasn't for that very collapse that almost took me out. So it's interesting how, the Lord taketh away and the Lord giveth,
Yeah.
as they say, and that those two things can happen at the same time. Now, would I do anything differently? Well, there would have been a lot of things I could have done differently that would have made my life easier, or things that maybe I should say, things that I wouldn't have done if I hadn't have done, things would have been much easier. There's a lot of deals that if I didn't buy them, I would have been in a better position. But I think, in reflection, I don't think I would change a thing though, because even those extreme difficulties is what gave me experience, judgment, knowledge. You never pay more attention to anything than when you're losing money in it. That's when you pay attention. And I think I wouldn't be who I am today or where I am today if it wasn't for even the things I did that I wish I hadn't have.
Yeah.
So no, I wouldn't change a thing.
Yeah, and I also think that it's a newer syndicators, which we've been talking about, if they haven't been through like a big market dip like 2008, 2009, they may not know what to do or how to prepare for that. Those of us who went through it with a bunch of properties around know what can happen, how to try to prevent it, or at least see the signs early enough to be able to, reconfigure whatever we had to.
Yeah, and if you don't, you figure it out. And it's that process of figuring it out that gives you such massive growth. I often tell people it's like, oh, I want to buy 200 unit apartment complexes. Well, what have you done? Well, nothing. I've done single family and it's like, well, try getting a 10 unit or a 20 unit. And if you survive that, then try getting a 50 or a 60 unit. And if you survive that, then go get a 100 or 200 unit, because you're going to learn so much from those smaller properties that you're going to be able to take that with you, and it's going to make you a much better investor than you would have been. And there's this old saying that says, like, the bigger they are, the harder they fall. If you do that 200 unit as your first deal and that thing tanks, you're finished.
Yeah,
you're never coming back from that. You're done permanently for life. Now, that happens in a 10 or 20 unit, it's a major setback, but you'll be able to come back from it and you'll be stronger and better for having done it. And so there's a lot of people out there who say, like, don't just jump straight to the top. Don't waste your time with the small stuff. I'm a real believer in organic growth.
Yeah, I agree. And I think operationally, someone has to understand maybe what they're going to be good for, because buying a 10 unit on your own is one thing. Buying a 100 unit on your own is one thing. Investing passively into someone else who's managing a 100 unit is a much different thing. You may not be ready to do it yourself, and sometimes you don't know. That's why it's so important. Like you said, with the organic growth, you can learn if you really want to be a landlord when you're up to about 10 units. You'll know if it's for you. It's not for me. And we've had a lot of properties, but my sister was the buffer for those. I did collections for my dad growing up, and I was like, I really don't like begging everyone just to just pay their rent. It just wasn't for me. And that's why it's kind of still crystallizing now. Like, hey, why wasn't I doing syndications a long time ago? Because then I can feel like I'm a part of the voyage without having to do the active management. Have you seen people who've come to syndications because they weren't a good like mini operator on their own?
Well, yes, me. I'm one of them, right? As I learned early on in my career, I am a terrible landlord. I mean, I was the worst. I mean, I was too soft. I remember one of my first rentals. It might have been like my second or third rental. I had a couple of young girls that wanted to rent it. And, it was like, oh, we just got finished with school. We just got these great jobs, blah, blah, blah. They had said all the right things. And, they checked out okay, credit, everything looked good. So I read all the books on how to be a landlord. So I knew what I was doing, right? And I know you always get that deposit in a cashier's check. Always, because you may never see the money ever if you don't. So I get there to hand them over the keys, and they give me the cashier's check. And I'm like, we didn't have time to get to the bank. So would you just take a personal check? And it's like, all right, we're here. I don't want to have to do this over again. Yes, here's the keys. Thank you for the check. Well, guess what? The check bounces. I mean, the book told me this was going to happen, but I'm like, no,
Right.
That's not going to happen. These are nice girls.
They're
This
nice.
yeah, that's not going to happen. So the check bounces. They never paid a dime in rent. They were there until the sheriff evicted them. And then they left all their crap behind that I had to deal with and take to public auction because they didn't even come get it afterwards. And it was just this huge disaster. And I realized, like, I'm a terrible landlord. So I had to scale and get big so that I could have a team around me that could do the stuff that I wasn't good at. I was good at picking real estate investments. I was good at capital structure, deal structure, engineering the whole process. I was really good at all that, but I was not good at like screening a tenant or making an approval or calling up and saying, hey, it's time to pay the rent. I'm not that guy. So I had to grow or I wasn't going to be successful in this.
Yeah, and it's so smart because if you keep doing the same thing that you not only not enjoy, but you're not good at it, you're losing double because you're not doing well that somebody could do better, but you're also losing time that you could spend finding more deals. Like trying to evict a tenant is a big waste of time. You could be finding another complex. I found that too. It's the who not how principle. Like, I'm not good at this. It's like I don't want to ever put anything together from IKEA because I'll just throw it out the window about 1/10 through because I like one diagram wrong, I'm done. And that's how I learned the same with real estate investing as a landlord. Like, I like the buildings, I like what the income comes, but I really don't want to deal with the tenant input. It's just too much for me.
Yeah, I mean, I've got a guy running my property management division who has 40 years experience in property management. He's managed about 50,000 apartment units in his career in almost every state. And, nobody's more experienced than this guy. I mean, he's one of the top property managers in the country. And he is the CEO of my management company, our wholly owned management company. He is in charge of that. And you don't get that kind of talent dedicated to your portfolio if you're out and buying onesie twosies. But that's also kind of the value proposition that real estate syndicators can bring to passive investors. Passive investors can bolt onto a platform like that by making investments with companies that have really solid teams, as opposed to going out and putting their money into that one rental house and going and meeting the tenants out there and saying, yeah, okay, I'll go ahead and take your personal check because you don't have a cashier's check with you. And, it's like, well, which position do you want to be in? Maybe you don't want to grow and buy thousands of units to do it. You don't have to. You can just invest with somebody that's built that structure already.
Yeah. You said something interesting in the pre-questionnaire that I sent you, and I've heard this a lot from other investors that have been guests on the show. What's going on in real estate investing world right now? You said there's a disconnect between what buyers and sellers think a fair price should be. That's still going on right now, right?
It is. We're recording this on August 1st of 2023, and I can tell you today it's still happening. And I'm guilty of it because I own property and we're also in the market to buy property. And I can tell you that as an owner, there's no way I'm selling any of our very high quality, well-performing assets at prices that buyers would want to pay today. And as a buyer, I can tell you that there's no way I'm paying those astronomical prices that these sellers want for their real estate. So there's this massive bid-ask spread. And the real question is, how long is this going to last? And that I think that's the $1 million question.
Yeah, I mean, it's also about like a desperation principle. Some people feel like they have to invest, so they're going to rush it. Oh, well, it's a good deal, but you're paying way too much. That's not going to work out later. Can you wait it out? But don't you think that on the horizon, it's going to eventually benefit buyers more as all of these commercial loans get into the trouble zone?
Oh, without question. I mean, these are the kinds of things that are setting up buyers for the opportunity to get some really good returns. Now, there's two ways that people make really good returns. One is to buy in the midst of a frenzy that happens to continue.
Right.
And then you get to get in and get out quickly and make massive profits. And certainly we were benefactors of that over the course of the last 5 or 6 years in properties that we would own, and they double in value in 18 months. And, you buy something for $25 million and sell it for $50 million, like 2 years later. You can make a lot of money doing that. But the other way you can do well is to buy at really good basis and then wait for the next market cycle peak.
Yeah.
And I've done that before, and we're geared up and ready to do it again. Question's just going to be, when do we hit the trough? Because, you don't want to get in too early. You get in too early, then you got to ride out more trough, or it's got to go down more, and then you got to wait for it to come back up. I'd rather buy at the same price 2 years from now and it's on its way back up than buy at that price today, watch it go down, and then come back up in 2 years and get back to even. And that's kind of what I think is going to happen right now. So we're just waiting it out, and we'll kind of taking a wait and watch and see approach.
Yeah, those are good points. I think if your goal is to try to buy at the bottom, you just may not know how far the bottom's going to go. So you could really put yourself in a hole if that's your only goal. Like you said, once you see it coming back up and you see the trajectory, sure, maybe you could have made more, but maybe just be happy with making like 80% and then riding the wave up, like you said.
Well, I think there's a difference also in what type of an investor you are. If you're investing your own money for long-term, like retirement type stuff, there's the old saying, every day is a good day to buy real estate, right? Yeah, buy now. And, there was a saying, what was the other saying? It's like, don't wait to buy real estate and wait.
Yeah.
And that's legitimate. So if you're thinking of making a real estate investment, sure, prices are better today than they were 2 years ago. This might be a great time to get into the market if you got that long-term vision. No problem. If you are a steward of investor capital, where you're getting money from other people to invest in real estate investments, which is what I do, I think it's better to wait right now, because it's all about return on investment. It's all about speed. It's all about, when do I get my money back? We've talked about this in this podcast already. I don't want to have to ride through that entire cycle. It would be better for me to be a week late than a day early, just because that's the business that we're in.
Yeah. So, I mean, you've tried basically every part of real estate, like you said before. If for a brand new real estate investor, like in today's market, what would be at least one piece of advice or asset that you would say, like, start there right now, 2023, we are recording August 1st, like you said. What would be the best advice you could give someone who wants to get in now? It's a weird time.
It is a weird time. I mean, I think if you have an absolutely iron stomach, maybe getting into office properties might be, there's offices down like 50%. And there's some trades are like 70% discounts to previous peak values. There could be some really, really interesting buys in office and that kind of real estate. I personally, I can't touch it. I don't have that iron of a stomach,
Yeah.
and it's a massive risk. So that'd be one piece of advice. I mean, I still believe multifamily has very strong fundamentals. I think smaller multifamily is maybe a better place to be right now. If you're an individual investor, maybe buying a fourplex or a triplex, duplex, maybe a 5 or 10 unit from a stressed out owner, you might find some deals. People want to get into the bigger stuff, like 100, 200 unit stuff. The problem with that is that those owners generally are very sophisticated. More often, they're well capitalized. They're waiting this out. There's not a lot of opportunity right now. Now, that may happen. We may get to the point where these owners just can't do it anymore. Their lenders are calling the notes due. They've reached loan maturities. They've got investor life cycles to contend with, fund liquidations, that kind of thing. There could be some distressed sellers in larger multi, maybe 6 months, a year, 2 years from now, who knows? But right now, if you want to get into multi and, you like the fundamentals, smaller multi may have opportunities hidden in amongst the haystack somewhere.
Yeah, I think that 5 to 10 units is really, really good just because people are still trying to house hack 4, 3, 2. 5 to 10 can't do it on the loan opportunity. So that's really there as an asset. And 5 to 10 is also like a little bit annoying for a tired landlord. It's just enough units to drive you crazy at 5 and more, so like they can really be getting like just a little more tired than 2, 3 units. More things go wrong, more things to replace, more leaks. Yeah, those are great points. I'm very interested in office too, but I'm the same as you. I just don't see how it's going to change unless there's an opportunity to redevelop into residential. But then that comes with a giant cost as well. But yeah, they're definitely sitting out there.
A giant cost and logistical challenge because
Absolutely.
offices are built as big, wide, cavernous spaces, and residential is built with windows and exits. And if you look at any residential building, they're generally quite narrow because you got a bedroom and a kitchen, and that's about the width of it. Whereas office properties have these big bullpens where you put cubicles,
Yep.
and you can't really put bedrooms in the middle of a 50,000 square foot building without any kind of like egress. So it's a little challenging, this whole office to residential conversion thing. And I mean, if somebody can figure this thing out, it could be really profitable, but I can't figure it out.
Yeah, it's tough. I mean, plumbing's huge too, because you're going from office buildings with like, one bathroom a floor to needing like, 16 different bathrooms on a floor. The plumbing changes are just too much. Electrics maybe better, but yeah, I agree with you. I hope somebody starts to figure it out so we can, get in on that little wave and then ride it up to the top because it's definitely available.
Yeah, maybe so. Yeah. And they have concrete floors. So good luck getting that plumbing in.
Yeah, exactly. Exactly. So where do you want to go with Praxis Capital? I mean, obviously you've been doing it for a long time. Is there something else that you want to get into? Or are you comfortable with the kind of 3 classes that we talked about earlier?
Yeah, I'm good. I've been there and done that in 3 decades of doing this, and I think now we're transitioning more into more stabilized Class A, maybe Class B to B plus multifamily assets. We're staying out of the Class C market. Definitely no Class D stuff. Nothing built before 1980. Preferring stuff built after 2000. So we're taking this flight to quality. That's the direction that we're headed. Now, will we build this thing up to, 10 or 20,000 units? I don't know. We had goals like that at one point. The market didn't deliver on them because the opportunity wasn't there. We got to 4,000 units and then saw that the market was peaking. And we're like, you know what? We need to sell. So we literally, over the last couple of years, we sold 3/4 of our portfolio in 2021 and the first half of 22 at what I believe to be the peak of the market. I think we timed it absolutely perfectly. So now I'm just trying to figure out how to time getting back in just right. And I'll probably be getting back in, remaining on that path of a flight to quality. And that's probably where we'll stay.
Yeah, I agree. Even on a small scale for me, I sold off a lot during the pandemic. The prices were just good coming out of the pandemic. Got rid of a bunch of old assets, took the hits there, and now just kind of like waiting to figure it out, which is what's led me to really doing much more research on syndications because I'm getting older. I have a bunch of other stuff that I'm doing that I don't want to focus on. Like I like flipping, but the day-to-day of flipping is just like a lot. I need buffers, multiple buffers in that for me. So I really think like syndication's becoming something that's so accessible to me now after all these years. So we really appreciate you coming on the podcast and obviously writing the book. I'm just about finished with it. I think I have about 30 pages left. But yeah, it's been a pleasure to talk to you, pleasure to meet you. You'll be at BPCon in October also, I believe.
I will be, and I'm moderating a panel on multifamily syndication. So
Awesome.
or actually, it's not multifamily syndication, just syndication in general. Moderating a panel on that with 4 great panelists, all friends of mine. That's going to be really exciting.
Yeah, awesome. Well, I will see you there. I'm going to panel about deal finding with 4 others, and I'm looking forward to meeting you there and meeting everybody else as well. But Brian, thanks so much for coming on the podcast. I really appreciate it.
Yeah, thanks for inviting me here. It's been fun.
Appreciate it. That was episode 69 of Zen and the Art of Real Estate Investing with my guest, Brian Burke from Praxis Capital and the author of The Hands-Off Investor, which I'm about to finish. I'm Jonathan Green. We'll see you next week. I hope you enjoyed that episode of Zen and the Art of Real Estate Investing with me, Jonathan Green. And I just want to remind you, and this is always an uncomfortable part, I don't want you to think that I'm begging for you to like, subscribe, follow, do whatever you have to do for the podcast, leave a 5-star review. But if you like the podcast and you think it adds value in the real estate investing sphere, then just do me a personal favor. Like the podcast, follow it, share it when you can with your friends, and be so kind as to write a 5-star review if you believe it deserves a 5-star review up against what else is out there. I would really appreciate it, and I hope you keep listening.